and then refreshed our deep dive on Solana to look at like who controls the chain, who can stop it. What we concluded is that the ETH and SOL assets at this point are fundamentally the same, that no single entity controls more than 20% of the Solana outstanding, nor can they halt the chain unilaterally. And so this SOL asset is, a utility commodity that gives access to the second largest open source app store.
This content is brought to you by VeChain, which is a leading enterprise-grade Layer 1 public blockchain spearheading a digital revolution from a sustainable, highly scalable smart contract platform. The VeChain blockchain has many unique features, which makes it an ideal choice for Web3 applications. VeChain is working with many great enterprises such as PwC, Givenchy, BMW, and Walmart China. Most recently, they partnered with the Boston Consulting Group to build a revolutionary decentralized application ecosystem. I'm a big believer in this project. I have been since 2018. I've been a VET token holder for years. And this blockchain is highly scalable, great with security and speed, and it has low energy consumption. If you'd like to learn more about VeChain, please visit vchain.org. Link will be in the description. Welcome into the Thinking Crypto podcast. I'm your host, Tony Edward, and with me today is Matthew Sigel, who's the head of digital assets research at VanEck. Matthew, great to have you on.
Hey, Tony.
Matthew, lots of big news around VanEck and the Solana ETF application that you guys filed. So I have a lot of questions around that, but let's start with your background. Where are you from and what's your professional background?
Sure, Tony. So I grew up in New Rochelle, New York, a suburb of New York City. I went to school in Boston at Harvard, and I guess that was the first time that I got very disillusioned with a name brand institution. Started my career in journalism at Bloomberg and CNBC, and I think I was relatively early to recognize the phenomenon of fake news, whereby journalists often leave out the most important part of the story, or at worst, blatantly misrepresent the implications. So I left journalism, got my CFA, and worked on the buy side at AllianceBernstein for 4 years, covering tech stocks for Cathie Wood before she left Alliance and founded ARK, and learned a lot about how to identify disruptive innovation. But I also learned a few things about how I didn't want to manage money. So left her, spent 10 years on the sell side, discovered Bitcoin and crypto, which I was kind of primed to embrace. We were big open source investors at Alliance, and had a hunch that these mega profitable tech companies would be disrupted by a combination of regulation and technological disruption. And I think cryptography is that technological disruption, and Bitcoin was the first killer app. So joined VanEck 3 years ago to try to broaden out our suite of intelligently designed investment products to give investors exposure to this fast growing space.
A real quick question on, you mentioned fake news and lack of integrity and things like that when it comes to journalism. We're seeing new platforms being built to help validate content and to where this, the source, and putting it on the blockchain. Do you think that's going to help to bring a bit more integrity and avoid fake news in the media industry?
I definitely hope so. I think one of the biggest issues for data is the provenance of the data. Where did it come from? What was its origin? Through whose hands or servers has it passed? Has it been manipulated? And cryptography is a handy way to achieve that transparency without giving up personal identifying information. So we still have, I think, a fair bit of progress to make on scaling and costs to bring this technology down so it's accessible for, the types of platforms that have hundreds of millions of daily active users. We're not quite there yet, but optimistic that these open source databases are going to take market share year by year, and much of the value will accrue to, a handful of the top crypto assets, we think.
Yeah, that absolutely makes sense. Um, Now, you mentioned you spent some time working with Cathie. Are there any interesting stories you can share? It's okay if not, but I'm curious, did you guys spend some hours talking about Bitcoin and these things?
So this was from 2007 to 2011. So
Uh,
Bitcoin had just been born. It did come up in morning meetings, but there was no way to invest in it, and our mandate didn't allow for it. But we were primed for the disruption that open source would bring to these digital platforms. And so after I left Cathie and was on the sell side writing research and selling research for a Hong Kong based stockbroker, I was kind of primed to embrace this technology. And part of it was doing research on the profit margins of Google and Facebook at the time. I got conviction that the open source databases would take margin away from these companies, and that consumers would gravitate to the open source alternative because of the global nature, the lack of censorship, and the kind of the intersection of social media and capital formation. And that's one thing that I think Cathie got very right in the founding of ARK Invest, was leaning on social media as a distribution engine to create an alignment with your customer base. And once you have that alignment and trust, then the customers will, in her case, buy the fund. But in the case of crypto assets, right, they'll get on board with testing the technology, becoming a community member, buying the NFT. And in that way, I think that, social media really jump-started a change in how capital formation happens in this country. And then when you combine that with crypto, it's just, fireworks on top of fireworks. Some of that skirts up against the regulatory issues, right? So if these assets are securities, then there's issues around disclosure that oftentimes, with small cap tokens are not followed, and there is kind of bad behavior going on there. But we think the largest cap tokens are now securities, and it'll be interesting to see how the regulation sorts itself out, given the realities of that social media.
Yeah, great point. And I will have a follow-up question on that because we're seeing this very interesting dynamic, Matthew, where it seems a little guy now can come together with a group of people, crowdsource, right? You look at GameStop, Roaring Kitty, AMC, and obviously you crypto and meme coins. And because of the internet, people can be distributed globally, crowdsource, and go behind a stock or a crypto and go against hedge funds. Uh, what are your thoughts on that? And how does that trend continue to grow where maybe the guys on Wall Street are not as powerful anymore?
I think that's totally true, and that's why I got into this space. I remember when I was first buying Bitcoin, 2017, the first half of 2017, and I had just come back from a business trip. I was, selling this research, and I was hearing about Bitcoin from taxi drivers, and I came back to my office surrounded by these finance guys. They're like, "Oh, you don't listen to the taxi drivers. They're the last ones to know. That's the sell signal." And I thought to myself, like, no, this is a retail asset that's meant to take power and economics away from the vested interests. You want to hear it from your taxi driver. Probably the last person you're going to hear it from is your stockbroker, because the technology itself is likely to hurt their profits, the stockbrokers, over the long run. And so they're trapped in this innovator's dilemma where it's easier to explain away the power of the technology rather than to embrace it.
Yeah, that absolutely makes sense. Now, tell us a bit about VanEck. I know about VanEck. I've spoken to some folks at the company in the past, but for those who may not know, tell us a bit about the history and what you guys do.
Sure. So VanEck is a traditional ETF and mutual fund manager with about 100 billion in assets under management. The firm started more than 70 years ago. The current CEO is Jan VanEck. His father was going to business school at night, learning Austrian economics, an immigrant to the US, and he started an international mutual fund. This is the late 50s. He was looking to profit from the Marshall Plan, the rebuilding of Europe post World War II. But it was quite innovative, actually, to have a non US mutual fund, one of the relatively early ones. And in the late 60s, he got concerned about inflation and worried about the gold peg depegging. And he pivoted that international mutual fund and put nearly all the assets into gold mining stocks. And it turned out to be the best performing mutual fund in America in the 70s. And the firm's reputation and asset base was really built from that mentality of hard money, classic economics. So when Bitcoin came around, Jan VanEck, now running the firm, looked at this new technology as a potential disruption to our gold mining profit pool. And he embraced the innovator's dilemma, bought Bitcoin, started investing in venture capital throughout the space to get smart and build a network. And now we're in the market with $2 billion in assets, in digital assets, more than 15 different products, ETFs in Europe, US, Australia, and a couple of actively managed liquid token funds as well that we run out of New York. So we're a macro shop. We're looking to profit from multi-year themes and design like intelligent investment vehicles that allow our clients to come along for the ride. So we eat our own cooking here pretty aggressively. We think we have a pretty good menu of options, and everyone's pretty heavily invested in our funds, and that's how we create an alignment between employees and customers. So it's interesting as a macro shop. If you look at the assets we own, it's about 55% equities, about 30% gold mining, gold and natural resources, and then the balance of the 15% or so is in crypto and some fixed income strategies. But you can tell from that asset mix that we're not overweight bonds. We're very worried about fiscal deficits, about the sustainability of some of these fiat currencies, and we have large overweights in commodities and natural resources, Bitcoin, and digital assets.
Now, with regards to the outlook of the crypto and digital asset space and asset class, do you believe that 15%, maybe over the next 10 years, is going to grow to 50%? And hear me out here, not just, okay, Bitcoin, Ethereum, but tokenization of bonds and tokenization of different commodities and so forth can be classified under the digital assets umbrella?
Yep, it could be. The way that Jan talks about it is right now digital assets are roughly 2% of our asset base, and he could see that percentage growing to maybe match gold over time, which would be like in the 25% range. Right now, our earliest efforts have been in the number go up technology, i.e., trying to identify which tokens have the right mix of mass adoption, solving a real use case in a way that's meaningfully better than the TradFi alternative, and where the token itself has some structure which will create value, not just suck value. So further on down the road, once Bitcoin hits our target price, which is $325,000, we'll be a lot more flush to experiment with maybe some of these on-chain security digital assets. But right now, we think the profit opportunity is in kind of holding the open source assets ourselves, and using them, building on top of them. So we've got an NFT project in the works. We're going to be coming out with a stablecoin this month to compete with Tether and USDC, and I think you'll see some more tokenization, over the long run. But the near-term opportunity is that it just feels still very early on Bitcoin, ETH, Solana, and we want to make sure we allocate our capital, where it's going to compound the fastest.
Couple questions on that stablecoin that you're working on. One, which blockchain are you launching it on? And will it be on multiple blockchains, like interoperable with different chains? Two, how are you planning to leverage that stablecoin? Is it similar to what Tether does, the lending and borrowing and so forth?
Yep. So the stablecoin is called the Agora dollar, and the founder is Nick VanEck, who is Jan's son. He was a partner at General Catalyst, which is a prominent crypto VC in the space, and we've identified that Tether is over earning, that Circle USDC is somewhat hobbled by their competitive agreement with Coinbase, whereby Coinbase essentially gets half the economics that Circle earns on the interest from their reserves. And Nick thinks that by being more aggressive and sharing the interest with distributor partners, whether that's crypto exchanges, decentralized exchanges, Fortune 500 partners that want to offer stablecoins to their clients, that we can start a price war and take meaningful market share from both USDC and Circle. It's going to be a multi-chain offering. You'll see it on Ethereum first here in the next week or so.
Wow, that's exciting. And I've been talking a lot about it recently. I actually just interviewed Jeremy Allaire of Circle last week. I published the interview yesterday. So it's fascinating. The stablecoin wars are heating up. You got PayPal's stablecoin. I think Ripple is looking to launch a stablecoin as well. So I'm very excited to see your version and how things, how the market reacts to it. But very exciting stuff. Tell us about the type of customers that you work with. You have ETF products, so I'm assuming retail can invest in them. And are you working with institutions? And if so, how so with crypto?
Yeah, so the US ETFs are about 75% of our assets. And one of the tricky things about ETFs is you can never be completely sure who the beneficial owner is. So we have a mix of retail clients, institutional clients, and high net worth clients. The way we go to market with retail is via advertising, social media, publishing our research. Whereas for the institutional client base, it's more of a channel-based approach. So historically, we have strong relationships with some of the larger bank-owned broker-dealers like Merrill Lynch, Morgan Stanley, UBS. We also work with some of the independent advisors like Raymond James and LPL. And there it's about getting the investment product approved to be on the platform, and then working with both like chief investment officer types and also individual advisors to get them comfortable about the investment thesis and the product features. So I think one of the early takeaways from the ETF, the Bitcoin ETFs that came to market, is most estimates are that up to 80% of the purchasers of those ETFs were retail. End customers who, probably gravitate to the BlackRock and Fidelity offerings with their, large brand names, large marketing budgets, whereas some of our more traditional bank-owned stockbroker clients, like those UBSs, the Morgan Stanleys, they're taking a slower approach, and they have yet to release the type of macro models, these like 60-40 type models that might introduce Bitcoin at a 1 or 2% weight. And that would give the advisors that like 30,000-foot air cover to go out to their clients and either put these products in just on a fully discretionary basis, or else to take orders. So we're optimistic that it will be one of the developments of the second half, is wider availability of the Bitcoin ETFs among more of our traditional channel.
And Matthew, I have to ask you, are you the intern on the VanEck Twitter account?
I will never answer that question. We need to protect the intern, very valuable member of the team.
I love it though. I love it. And I noticed a common theme, that you were mentioning is social media, and that seems to be the way to engage with folks now. It's very much a personal feel, and with memes and really, I guess reaching out and touching people versus just a TV ad or commercial, right?
Yeah, I think, the way to generate conviction in any investment really is to share views with partners, clients, competitors, hear the pushback, coalesce around what the kind of best risk-adjusted bet is, and then tell people what you're doing so that they can hold you accountable when things change. So do think that social media is, a really great way to reach clients and to form that community.
Yeah, absolutely. Let's talk about the Bitcoin ETF inflows and performance. I certainly want to talk about VanEck's, but even from the macro, I would love to get your perspective. Are you blown away by the performance? Were you anticipating this type of performance and inflows?
Uh, it's been a great launch. I wouldn't say we were blown away, but to have $60 billion in these products after 6 months, I think that really alerted the world that this asset class is here to stay. And then when we saw the types of buyers, the thing that really stuck out to me is hedge funds bought twice as much of the Bitcoin ETF as the advisor community, right? But advisors manage 20 times the assets from hedge funds. So this was the early, more nimble institutional investor community that was essentially front running the work that the advisors are going to have to do. And I think when we look back on this in a year, the advisors are going to own, 3 to 5 times what hedge funds will own, and Bitcoin will be up, more than 100%. So it was a great launch. Not thrilled, not totally surprised. We've had on the VanEck side about $500 million worth of inflows into the product year to date. That is a tremendous launch by any other comparison. But I think there's going to be triple the amount of assets in these Bitcoin ETFs a year from now. North of 150 billion.
Wow. And how, as much as you can tell us, how is VanEck approaching these RIAs and wealth managers across the country and even globally with your other products, and educating them and getting them to be comfortable with this?
Yeah, I mean, I think it's a reasonable question as to how to differentiate. When you have a regulator that allows 11 identical products to list on the exact same day, despite the fact that some issuers filed 7 years earlier, it's going to give an advantage to the big guys. So, I think that's the story that has played out. I think the way that we're differentiating is, number one, skin in the game. I mentioned that we eat our own cooking pretty aggressively here. So we put a $70 million seed into the HODL ETF. That was 3 times larger than our second largest competitor. And that's just a message to the clients that when Bitcoin goes through a drawdown, we all know it's going to be down 50% at some point. People are going to be freaking out. They're going to want some hand holding, some research. They're going to want to talk to someone who's wearing that same pain. We'll be along with them for that. We've also put out significant amount of research on our website, like 300 research pieces in the last 3 years. We have price targets for most of the major assets, and we're hopeful that research will help us differentiate. And then the third is that tickers can be differentiating, and we think we've got the best with HODL.
Now, speaking of the downturns, right? And people saying, oh, well, I need to take out profits or whatever it is, or this is crashing again. And this may be a tough question. I hope I articulate it well. But the IRAs, they're incentivized to make their clients as much money as possible. They rebalance the portfolio and so on and so forth. How are you approaching them to handle these ETFs? Is it, hey, Bitcoin, you want to have a long-term outlook. Let's talk about 2030, holding till 2030. Or do you think it's going to be a mix, 50% long-term, 50% people are going to want to rebalance and take their profits, depending on the cycle?
Yeah, I do think that as more institutional investors allocate to the space, there will be more pressure to realize profits after parabolic moves. And we did see some of that over the last couple months. Long-term holders of Bitcoin becoming net sellers on balance over the last couple months. We run some model portfolios here at VanEck, multi-asset portfolios, where the Bitcoin target weight is something like a 3 to 7% allocation. And in that model, the portfolio manager recently took some profits with Bitcoin over 70K to bring that allocation back down to the 4 to 5% range from where he'll let it run a little more. So there will be, I think, a dampening effect over the long run as more and more allocators get into this space. But per my comment on the hedge funds owning twice as much Bitcoin ETF as the advisors, I think the penetration rates are just still very, very low. And we have, another cycle ahead of us, probably turbocharged by the election, before you've got like the mainstream allocators in at 1% and, willing to take profits on either side of that.
Let's talk about the Ethereum ETFs. Bloomberg, their analysts are reporting next week. Oh no, this week, excuse me, Matthew. We may see the approvals of the S1s. What is your personal take on that?
Well, we're limited on the details we can provide because it is an active filing. But Gary Gensler was at a conference last week, and he described the Ethereum ETF process as running smoothly. So I guess this will be the only time that I don't disagree with Gary Gensler about something. And yeah, definitely hopeful that we'll have these out before the end of the month.
Any predictions as to what the inflows may look like? Maybe it's 20%, 30% of what Bitcoin saw.
But most estimates are in the kind of 10 to 25% range. I think those are reasonable. I do think in the US, the lack of staking will maybe decrease the attractiveness a little bit of these products. When I look at my own Ethereum holdings in the liquid token strategy that I manage, the staking has added material returns to my performance. And it really, what's so amazing about staking is that it forces you to dollar cost average because you're locking up your liquidity and you're getting little bits of Ethereum every single day, even when the price goes down 20%. And then when it rallies, the dollar value of those new coins that you have received from staking provides a real turbocharge. So ETH staking's added like more than almost 1,500 basis points of performance to ETH since the September 22 merge. Maybe that'll keep some folks from kind of jumping in the way that the SEC is treating ETH staking so far. And can't say that the ETH ETF flows like in Hong Kong have been so tremendous. So, but even let's say that we're, at the low end of those estimates, like call it 10%. That's still a couple $1 billion of ETH flows this year for a less liquid asset. We still think that could be quite meaningfully positive for the price.
So tell me, Matthew, I obviously crypto regulations are being worked on. A lot of these things are being sorted out in courts, but do you have your staking application ready to go the moment we have some clarity?
I'm not going to comment on that specifically, but I will say that we have a spot Ethereum ETP in Europe, and we recently started staking our Ethereum in that fund, and we're up to about 70% of the fund is staked. So that adds up to north of a 2% yield for the shareholders. I think it's a pretty attractive addition. We've done a lot of due diligence on the staking providers, and eager to engage with the regulators and help make that a reality in the U.S. But to be realistic about it, probably a post-election development.
Yeah. All right, let's talk Solana ETF. VanEck was the first to file in the United States for that. But what we've seen, the process has been a futures market, then a spot. Tell us about your thesis behind the Solana ETF application.
Yeah, so when we looked at our Ethereum filing and examined the language around decentralization and the characteristics of the blockchain, and then refreshed our deep dive on Solana to look at like who controls the chain, who can stop it, what we concluded is that the ETH and SOL assets at this point are fundamentally the same, that no single entity controls more than 20% of the Solana outstanding, nor can they halt the chain unilaterally. And so this SOL asset is, a utility commodity that gives access to the second largest open source app store. And we're optimistic that over time the regulator will approve these products. I know that there's a lot of focus on the existence of a regulated futures market of significant size in order to give the regulator the transparency to get comfort that the market is not manipulated. But frankly, we think that the focus on that regulated market of significant size, the futures market, is a Gensler psyop. There are other ETFs in the market that cover the power market, the electricity market, the shipping market, the uranium market, where the futures market is just immaterial to the price formation in those markets. So we think this can get done, but probably might need a different SEC chair.
Sure. Yeah, and I noticed Canada, I don't know if they have one live or they filed for application as well, but given that you guys are international, have you launched a Solana ETF in other jurisdictions?
Yes, we have one in Europe. And that's been trading for almost 3 years.
Oh, wow.
Yeah.
Yeah, I totally missed that, but that's incredible. So you pretty much know what you're doing from a Solana standpoint. And it's just a matter of getting through the regulatory hurdles here in the US.
Yes.
So let's talk a bit about Gary Gensler and the SEC. There's a lot of court battles happening. Coinbase, Kraken, many different companies are suing the SEC and the SEC suing them. So Gensler and the SEC have been taking some losses in court, and this could be resolved, as you hinted, past the election, a regime change, and so forth. What are your thoughts on these things getting resolved? Is it a 2025 thing that maybe Congress is able to pass regulations through Gensler, maybe out of there? What are your thoughts on that?
Yeah, it's a very schizophrenic situation right now, because you have federal judges like the one in the Ripple case in 2023, and then just last week in the Binance case, who are ruling that the secondary sales of many of these crypto assets, so XRP or BNB, are not securities transactions and do not fit under the Howey test. And yet, the SEC's lawsuit versus Coinbase for those very issues remains outstanding. So I have to think that over time, the two rulings, the XRP and the BNB ruling, are very positive for the Coinbase suit. And what I think will happen is that the various attorneys that are working on the Coinbase suit will start to quit the SEC, and they will soon become general counsels at XYZ Crypto Exchange. And this is exactly how this works. If you look back at when the SEC sued Point 72, Stevie Cohen's hedge fund, all the litigators working on that case, you just see them pop up, general counsel of hedge fund A, hedge fund B, hedge fund C, and before you know it, the case collapses or settles, and that's what I think is going to happen.
Yeah, it's funny you mentioned that because we've seen Jay Clayton, former SEC chair, go work as an advisor for the crypto industry. Bill Hinman goes to A16Z. And then, you got a bunch of SEC lawyers that have been quitting. Some got sanctioned in the debt box case. What a mess, man. And hopefully 2025 is the year that we can get this all resolved because it's just crazy.
Yeah, I mean, a new president appointing a new SEC chair and giving him some instructions about how to approach this asset class, notably less enforcement, more friendly to entrepreneurs. Those couple of those simple things. Let one quarter pass, and I think we've got the Sol ETF out the door and some others filed.
There's been a lot of talks about, in addition to Solana ETFs, XRP ETFs. Are you guys looking into that at all?
I think in order to bring an ETF to market, you have to have like a few different stakeholders on board. You have to have, the regulator obviously has to approve the underlying asset. The issuer has to have conviction that the asset's a good investment. You have to have counterparties like exchanges, market makers, custodians who also rally behind the asset. And then you have to be able to find customers who want to buy it. So when we think about Solana, we've got all of those buckets. When we think about XRP, we're missing a few of them: internal conviction and customer demand. So I'd say that one is less likely.
Hmm. And are you working on any type of basket ETFs for these coins? Obviously, it's kind of early. We need to get the Ethereum out first, but eventually, let's say there's a Bitcoin and an Ether running in the market, establish maybe here's a top two basket, and once you get Solana, here's a top three. Are you planning to do things like that?
Without speaking to specific plans, if you look at our ETF lineup in Europe, we have a top crypto product, which is the top 5 assets. And then we have a smart contract leaders ETF, which is top 5 layer 1s. So, as you noted, there is a roadmap to bring these products to market in well-regulated jurisdictions like Europe. And I feel like it's inevitable at this point that if it's not us, someone else will do it. You have the beginnings of them in the US, like the Bitwise 10 product, BITW. The problem with that thing is that it trades, let me just check here, at the discount to NAV. It is a 30% discount to NAV. So you could buy it today, maybe that discount goes down to 50%, even though the coins go up, you've lost money. And it really is going to require clarity around, first and foremost, that the Sol ETF can get to market, and then I think issuers will try with the other proof of stake coins, and then the building blocks will get put together, and someone will do a top 5, top 3.
Hmm. Quick question about custody, because that is certainly a big thing for folks post 2022, right? I'd love to learn about who you're using as a custodian for your digital assets. Is it a similar firm that custodies your other assets?
So in the case of the Bitcoin ETF, we are using Gemini from the Winklevoss twins exchange, and we have a long-standing relationship with Gemini. They are licensed under the New York Department of Financial Services. And if you read the book Bitcoin Billionaires, you'll read some anecdotes about how they approached custody, literally driving around to banks in the Midwest and depositing the private keys into safe deposit boxes, diversifying the risk. Very responsible custody method. And I think that provides some diversification because nearly all the other issuers are using Coinbase. For our liquid token funds, we use a mix of custodians. So for strategies that are run out of the US, we use qualified custodians, and that means practically speaking, Coinbase Prime and Gemini. And then for our overseas strategies, where we can be a bit more flexible with counterparties. I should add in Anchorage is another qualified custodian. Yeah. And then for our overseas strategies, we do a bit of self-custody using software solutions like Fireblocks that allow us to hold on to the private keys ourselves with a risk managed approach.
Follow-up question on that. Do you, and this is something I've been thinking about, like you mentioned, a lot of people have been using Coinbase custody. And in the back of my mind, I'm like, this seems like a centralized risk if all these players are using Coinbase. And I'm not hoping for a downfall or anything. I hope that doesn't happen. But I would kind of how you guys are dispersing, your funds and so forth. I wish there was more people doing that. Is there any concern for you, even if it's 1%?
Uh, these are, very well regulated bankruptcy remote entities. So in terms of like governance or governance risks, is Gemini or is Coinbase going to run off with those assets? That seems like a very low risk. There are smart contract risks, of course, but there's insurance on those wallets, so we can manage it through that as well. Do recommend diversifying one's custody risk. And I think that's one reason why the ETFs have picked up so much market share, is that even for individuals or companies that are very comfortable with self-custody, it's helpful to diversify and get a third party to hold on to at least a portion of your holdings.
Yeah, absolutely. All right, Matthew, I got some wrap-up questions there for you. First, if you could create your own metaverse, what would the theme be?
So I'm a big reader of books, especially nonfiction, history, biographies, true crime, that sort of stuff. I would like a metaverse that is like chapters of books, right? So it's not like if you read this book, you'd like this book. It's if you read this chapter, you'd like this chapter. And then it's where people come together and like talk about those, links and, get nerdy about various books. I'd say that would be my metaverse.
Nice. Some rapid fire questions. First, favorite food.
Favorite food is sushi. I've lived in Japan twice, speak Japanese fluently, so know my way around the sushi bar.
Nice. Favorite musician or band?
I am not a big music guy or movie guy, frankly. Like
Yeah.
I'm all about the books. So I can get into like authors and things like that, if that's helpful.
Well, what's your favorite book all time?
I'd say my favorite book is How Innovation Works by Matt Ridley. Goes back over history, examines like some of the most groundbreaking inventions in history, and analyzes like what circumstances were in place in order to turbocharge this innovation. And the answer is usually collaboration and a spirit of freedom. So I love the Matt Ridley books.
I'll check that one out. And when you're not working at VanEck, what are you doing for fun?
I am always working at VanEck, so just obsessed with crypto prices, reading books, walking the dog.
I think that's a clue that you are the intern, man. That's my story. I'm sticking with it. Matthew, pleasure chatting with you. Excited to see the launch of the stablecoin next week. And also for you guys leading the charge on the Solana ETF. Really exciting stuff. Thank you so much for joining me.
Awesome, Tony. It's been fun thinking about crypto with you this hour.